So we often say that the credibility of central banks gets enhanced because it's able to deal with shocks without producing a big slack or an output gap when a shock hits, right?
So my own view is that there is something, that flexible inflation targeting is very, very important, because the market view is the canonical view of inflation targeting, which is what we read in the textbooks, which are largely developed for advanced economies and a mature sort of financial market.
My point is that if you look at the performance of inflation targeting, the first half up to 19 we did very well, but there was serious problem with the second half because of these exogenous shocks.
Every advanced economy had inflation running up to 10% once the pandemic recovery was there. We didn't go that far. So I think even for the period of the pandemic, we have to qualify that it is reasonable success because it was extraordinary situation.
So let me start with Dr. Ghate. You are sitting next to me, so I'm following that pattern. Your view of the 10 years of MPC framework, from your personal involvement, as well as you're seeing it from outside, that we have been seeing for the last few years. Dr. Ghate.
Thank you very much, Mr. Bhattacharya, and it's great to be sitting on the same panel with good friends who we're all partners in crime in a way.
Good friends, remember this.
No, I've learned a lot from all three of them, and there are also other people here, Mr. Boyo, I've not seen in many years, and I'm sure. But so thank you for inviting me. I'm really honored to be here. So I'm a strong kind of supporter of inflation targeting. And, but let's just look at, what the obvious benefits are. So first of all, inflation has tumbled in the last 15 years, right? So now the skeptics will say, this is regression towards the mean. What are the marginal effects of IT? Has IT really been responsible for reducing inflation down, or is it just something that is happening because of macroeconomic policy? But I think apart from this debate about mean inflation levels, the success of inflation targeting has also to be judged in terms of establishing the credibility of a nominal anchor. That's very important because prior to inflation targeting, we followed something called a multiple indicator approach or a checklist approach. The Reserve Bank was looking at lots of different indicators, and financial markets didn't understand what the central bank was doing, right? So now we've gravitated towards another system where the nominal anchor is credibly established. Headline inflation. So one way to think about this, the inflation targeting shift, is that we now have a credible nominal anchor. And there's some debate, and I think we'll get to this later on, about whether it should be core inflation, should it be headline inflation. My view, of course, is that it should be headline inflation. But establishment of a credible nominal anchor. Number two, also look at the credibility that the central bank has with anchoring inflationary expectations. Number two, that's something that is important. And number three is whether the volatility of key macroeconomic variables like inflation and output have fallen as well. So we shouldn't just judge the success of inflation targeting by declines in inflation, which has happened, but by establishing a credible nominal anchor. Number two, by the decline in volatility of key macro parameters like inflation and output. Number three. And number four, of course, because of anchoring inflationary expectations. So what inflation targeting has done is that it has raised the credibility premium. Now, this shows up in a variety of ways, but in the way that financial markets have probably appreciate and understand. In 2018, for instance, we had a tightening cycle, and 10-year bond yields went up to about 8%. And in the recent tightening cycle in 2024, the 10-year bond yield went up to about 6.5%. So we often say that the credibility of central banks gets enhanced because it's able to deal with shocks without producing a big slack or an output gap when a shock hits, right? But the other way to think about credibility is that the institution is better defined, the goal of monetary policy is clearer, and this is showing up in some of these metrics like 10-year bond yield rates and so on. The second thing I want to emphasize is that in terms of inflation targeting, there are a few other things. So we often think of the Indian government, so if you look at debt to GDP ratios, they're quite high. They are for many emerging market economies, but they're also for India. But what we show in some recent work is that the marginal cost of reserves, if you look at the opportunity cost, so if you have a lot of foreign exchange reserves and you're investing in them in US Treasury bills, you're making, let's say, 4.5% versus what you could get in terms of an Indian GSEC, right? So that's the opportunity cost. But what we show is that reserves actually reduces that insurance premium, and inflation targeting, because it reduces currency risk, also reduces that insurance premium. So the marginal cost of holding reserves is not the difference between the two 10-year bond yields, let's say, or comparable assets, but it is lower than that because of the effect that inflation targeting has had on the marginal cost of holding reserves. That's a second benefit. And then in terms of the criticisms, the score versus headline debate is picked up, in part because it was mentioned in the economic survey. But if you want to deal with, and the argument was that basically we should be targeting core and we should strip out headline inflation from its volatile elements because those are really not responsive to monetary policy actions. And then the argument given was that because we target headline inflation as the nominal anchor, rates may be high, and that's bad for farmer welfare. Now that farmer welfare is an important thing. All of us agree on that. None of us disagree with that. But my view on this is that if you want to deal with farmer welfare, then the appropriate tools are sectoral fiscal policy and transfers. Okay, monetary policy is a global policy. It's a general policy. It's not a sectoral policy. It is a global policy, and it has to be kept in mind. Has to be formulated in terms of the entire economy, conditions in the entire economy, as opposed to one sector. The appropriate to deal with that is to now in terms of so technically. The RBI has produced a discussion paper in which they show that headline inflation tends to converge to core inflation. So the argument there is that if that's true, then ultimately if price signals are being transmitted by underlying inflation, by let's say core inflation, and if headline is going to be moving around quite a bit because of these supply side shocks, but it ultimately converges to core inflation, then we should target core inflation. Let's just see through all the temporary shocks that are hitting headline, but there's a lot of academic work now that actually shows that it is core inflation that is moving towards headline inflation, which means the second round effects are important. That food price, at least the initial effects of food price shocks, which feed into wages and so on, ultimately affecting the trajectory of core, which ultimately affects the trajectory of headline, which suggests that we should not be targeting core and we should be targeting headline. So I think that debate in India has picked up, and I find it a bit confusing in all honesty, partly because there's this sectoral versus aggregate perspective, that any particular sector is going to, of course, have distress in it, but monetary policy, to change the nominal anchor to deal with that may not be the right approach. And of course, the second is this issue about headline converging to core and core converging to headline. And then finally, the discussion paper, and I'm using this as a template to think about things. There is this issue about whether 4% is the right midpoint. And the 4% was chosen for a variety of reasons, and the discussion paper actually does quite a lot of work on that, in part because core inflation is estimated to be 4% in India historically. 4% historically. And if you look at headline inflation, it tends to be volatile in the range of 1.5 to 7.8%. I mean, many of you track vegetable price inflation. Vegetable price inflation has moved around from about 40% in 2024 to about minus 20.7% in October 2025. But having said that, I think a symmetric band and point target is helpful for signaling. And the 4%, of course, is chosen partly because of the fact that, well, there's something called a Balassa-Samuelson effect, but I don't want to explain this here. But in part because the productivity differential between, let's say, the US and India has a cap of about 2%, and the US targets, advanced economies target roughly 2%. So the 4% is well-founded there. And I think so. I think my quick answer to your question is that a major structural reform was put into place, and prior to the enactment of the structural reform, there were many financial sector reforms that were enacted, which made monetary policy under inflation targeting easier to implement. That happened in the background, and the RBI kept chipping away at that and kept enacting major financial sector reforms, and that helped to the transition with inflation targeting. And after 10 years, I think it's by and large been a success, and it doesn't, in my view, at the current juncture, need a major rethink on kind of any of these major dimensions to it. Thank you.
Thank you. You know, I understand your broad message. No need for any major fixes. But one question may appear a little stupid. But if there is a convergence between core and headline, I'm just asking. Then, if they are converging at any case, why not core then?
Because if you have supply side shocks and supply side shocks, see, there's this issue of what do central banks do when they experience supply side shocks? First of all, it's very difficult to identify. That's the word that economists use. Identify whether a particular shock hitting the economy is a supply side shock or a demand side shock. Supply side shock could be discerned possibly after a lot of analytical work. So supply side shocks are different from demand side shocks. Supply side shocks, output falls and inflation rises. You know, spike in the price of oil, for instance.
So you can judge it.
You can judge
better.
it from the data. You can judge it from the data. But if you have repeated supply side shocks, and that begins to start feeding into wages and that begins to start affecting pricing decisions of firms, then that begins to feed into core inflation. And
Okay.
So on. So
okay.
you get this.
Excellent. Excellent. Dr. Goyal, your turn to give your verdict on the 10-year framework.
Yeah.
Yeah.
I think, again, it's, as I was saying, telling you also, it's a great panel. And I hope we get a range of views for our audience. So let me take a slightly different view from Chetan. And this follows on, I've been interacting with a lot of groups on inflation targeting and this monetary policy review. So there seem to be two sets of people. One, which I think one view which Chetan has expounded very well is the dominant view among market participants, where you think that what the RBI affects primarily is prices, and therefore inflation targeting brings that down, and it works well. And it has worked well. And another view is that what are we doing? Why is the RBI, focusing on inflation when it's largely determined by food prices and they have a dominant part in the basket, and the RBI can't affect food prices, and then it's likely to affect growth adversely. So my own view is that there is something that flexible inflation targeting is very, very important, because the market view is the canonical view of inflation targeting, which is what we read in the textbooks, which are largely developed for advanced economies and a mature sort of financial market. And in India, when we adopted inflation targeting, there was some thinking on this prior to that. In fact, one of my PhD students did a thesis on inflation targeting in the early 2000s, whether India is ready for it or not. But it was after a period of very high inflation, where food inflation had affected wages and it become persistent. So therefore, in a way, inflation targeting was rushed through without enough domestic debate, to bring these two groups together and to understand in what ways inflation targeting suits an economy like India also. And I think this review opportunity is an opportunity to really explain this to the public at large and to get views from markets and academics and so on, so that there can be a convergence on what is flexibility and how inflation targeting can be adapted to suit an economy like India. So the first thing is we need to look at data, and I absolutely agree with Chetan that inflation targeting has worked in the sense, because I've looked at data from the 1970s, the average inflation was 8.5%. And in the inflation targeting period, it is 5%. So there's a perceptible fall in inflation. But when you look at the growth data, then we see that in periods where, and this is a forthcoming paper, and also in an article I've given the details, that in periods where the real interest rate approached 2 or is greater than 1.5, you normally had a slowdown in growth. So one such period was 2018, another was 2024, just last year. And generally, so there's a large sort of growth sacrifice because real rates are allowed to go too high. But the answer is not to move away from inflation targeting, because you've had monetary tightening even before inflation targeting. And in periods of very high inflation, such as the 2010s and so on, growth fell. It wasn't that if real rates are low, then growth, because threshold inflation also matters. So what you really need is flexible inflation targeting. And here, again, I largely agree with Chetan about the questions the RBI working paper has posed, that their status quo is best. But I disagree with him a little bit upon this headline to core, where the headline affects core. That was the original, this very influential IMF working paper in the early years when inflation targeting was adopted. But a lot of research, RBI's own research after that, shows that after the adoption of inflation targeting, and also because that period you had very high food inflation, double digits, and so headline was affecting wages and core. But after that, the causality is from core to headline. So therefore, core is a more stable trend inflation, and the volatile components come towards it, right? So therefore, sort of my own view is that you need to stick with headline because that affects welfare, since food basket has a lot of weight in the consumption. But you should also announce the core. RBI doesn't announce its core forecasts. If the core forecasts are announced, that will bring inflation expectations down towards the more stable trend. Instead of people focusing on the price of parvals rising in the northeast and the theoretical determinants of inflation. And so there are a lot of, while I agree generally about the status quo and the questions the working paper poses, I think that they have not done enough to really to develop the expectations, the inflation expectations anchoring channel, which is the major channel through which the RBI affects inflation in a country like India. So although the aggregate demand channel, which is the standard one, it is, and again, research shows that the interest rate affects output first and more than inflation. So that is not a very effective channel in the Indian context. But in a hierarchical system where everybody is listening to what the governor is saying and the DGs are saying, when they communicate this 4%, I think it percolates down even to regulators. And so that is why I think you should stay with that 4%. Yeah? But there are many kind of operating procedures, I call them, that could be fine-tuned and improved. One is as I said, giving the core forecasts. Second is that, currently we are seeing that for the last more than a year, the inflation forecasts have been over-forecasts. This happened in the 2018 also. And because of that, real rates are kept too high. These real rates are again at about 2 or 3%. And if it persists for a long time, then it will adversely affect growth. But again, the forecast for the next quarter is 4.5. First it was 4.9, now it's 4.5. So, then according to that, you don't need to cut rates. But then those are likely to be overestimates again. So again, if you take this towards core, the core trend for the last few months, leaving out gold, more than a year, is 4%. So why don't you take that as your inflation, and communicate that, your inflation anchor. And then you have some space to cut, and then you don't, so focus more on average, because when inflation comes down, then that base effect has a large impact on your inflation. So, this 4.9 is because of the base effect. Because it is 2%, it's likely to rise. So instead, think of average inflation, think of month-on-month momentum, think of the impact of core on headline, and therefore headline will revert to the core, and some anchoring is taking place. Look at I've estimated firms' inflation expectations, because they are the price setters ultimately. The RBI only has a consumer expectation survey, not firms' expectations. And I find that firms' expectations now are about 3% for inflation, right? So these kind of operational changes. Then another issue is liquidity. And here I want to talk a little bit about what flexibility means in the Indian context. I think one of the things we could do on inflation forecasts is bring in more independent forecasts, including the external members should give their own forecast. This could be based on data. It could be their own sort of understanding of the economy, like the dot plots you have in the US, so that you have competition for the RBI's own forecasts, which could be conservative and mean reverting, and mean being past inflation rather than the expectation channel and the communication on expectation. So bring in more independent forecasts. Then flexibility. We assume that flexibility means just that you have 3 quarters to bring inflation to 4%. You have a band 4 to 6%. Again, I think that band should stay because we still have a lot of supply shocks, and therefore inflation is volatile. And if it is reduced at present, until the indices are improved, another thing that needs to happen is the share of food will come down once you move away from this 2011, 12 weight. You bring in an overall wage index, you bring in producer prices, etc. Then you can think of moving away. But at present, our inflation is too susceptible to supply shocks. But the other kind of flexibility is, again, Chetan had talked about earlier, we moved away from multiple indicators. In a way, in a heterogeneous economy like India, and globally also, there's this talk about financial stability being important. Our regulator is also the regulator of banks. So you cannot ignore many other issues. Exchange rate. We are seeing currently, if the RBI doesn't intervene and the rupee shoots towards 100, you can have overshooting and volatility that will hurt the whole economy. So they need to intervene. While canonical standard inflation targeting says no intervention, the exchange rate is the perfect float, liquidity, short-term adjustments, but we have large exogenous liquidity shocks. So you need to adjust for those, right? So again, I think that the liquidity, MPC, we used to talk about why liquidity was so tight. Last year, it became very tight. We would be told government cash is not, cash balance is accumulating, inflows and so on. But the point is that you can compensate. You have the tools, OMOs. You need durable liquidity to be in surplus in an economy like India, but not too much in surplus because that creates poor incentives for the financial sector. So again, like in the US and even in the UK, the MPC individual members have responsibility for liquidity also. They give guidance on that. So that would increase transparency and increase comfort in markets, because markets feel very worried when there's a tightening. They're not sure what will happen next. So just as a target, and the MPC talking about this increases the focus on inflation, similarly, they're talking about liquidity will bring more comfort to markets. Yeah. So these are some, and then other types of flexibility include the role of the government. The canonical inflation targeting talks about central bank independence. And that means that the government can't tell them what to do. They take independent decisions. They are focused on inflation. The government takes care of growth. But in a country like India, where supply side fiscal policies, the fiscal conservatism, bringing down the deficit and debt, and this reduction in risk premiums that Chetan was talking about, and that we've really seen, which has been a great benefit of inflation targeting. All that, one reason we could keep real rates somewhat low in the early years, and we saw 8.8% growth first 3 years after the pandemic, was because the government was taking very active measures to, so if you have that kind of coordination, as long as you keep your real rate positive, then inflation targeting is credible. And since your rate action is conditional on the government taking action on the supply side, it doesn't mean your independence is affected. So you are independent, but you have some coordination that reduces the growth sacrifice by canonical or strict inflation targeting. Okay. So these are various kinds of flexibility. Sure. I think I'll stop here. Because,
no, I think I just wanted one clarification. When you said flexible targeting, did you also mean that, let's say 4% is the target, right, and you only have a band of 2 to 6%. Are you talking about flexibility in that term?
No, that's what I'm saying is the understanding of flexibility inflation targeting.
Okay.
The MOU RBI has with the finance ministry is for flexible, but this is understood only in terms of this, we have a band, like a funny story if you want an MPC experience. Yes. Is like when inflation had exceeded for 6 terms, just after the Ukraine war and so on. We had to write a letter to the government.
Yes.
And we were seeing first time RBI is writing, so sample. We looked at the UK. And they have a strict inflation target. And that time, because of supply chain snarls, everybody's inflation. So they were literally writing a letter every month or something like that. Because there's strict point.
Because there's 4% is the target.
But I am saying that flexibility here means that you need different rules for liquidity infusion.
So in other words, you are recommending a change from the current system.
No, I'm not recommending a change. I'm saying the interpretation of flexibility needs to be expanded, the communication.
Okay.
That, because markets very often say RBI is intervening, shouldn't be doing that because this is inflation targeting.
I understand.
No, but you have other tools for intervention. You have reserves. If you have reserves, that means
Absolutely.
you are in, So to increase that understanding of how inflation targeting works in an
Fantastic.
economy like India.
Yes, sir.
Yeah.
Let me now turn to Mr. Raj. Lest you think that, I first tried the independent monetary policy members and then going for the RBI. No, it is not the intention. It is purely alphabetical, actually, if you notice this thing. So, Mr. Raj, go ahead.
First of all, thank you very much for inviting me. And
Sure.
it feels great to be in the company of my former colleagues.
Yeah.
So
Mike,
my
yeah.
remarks will be divided into three parts.
Yeah.
One, I will talk about the flexible inflation targeting framework briefly, touching upon some of the points which Chetan Ghate and Seema Goel have raised.
Yeah.
My second point would be on the how has inflation targeting framework performed so far. More than 10 years have passed, and the next review is in March 2026, and that would be the point, discussion point for my next remark.
Yeah.
So, we adopted the flexible inflation targeting framework in October 2016. That was the time when the first meeting was held. But the backdrop of that was multiple indicator approach, which Chetan mentioned. If you see that period, actually multiple indicator approach is not any framework. It's just do it. So we were monitoring a lot of indicators, and market was not really clear what we were doing, and there was no anchor. So we needed some nominal anchor, and that's how the 4% target under flexible inflation targeting has provided. Now, let me just briefly touch upon what is flexible. Flexible basically means that we take into account, because when the inflation targeting framework started with the Reserve Bank of New Zealand, they were basically hardcore inflation targeters. They focused only on inflation. They didn't care about financial stability concerns or growth concerns, which happened then during that global financial crisis in 2008. So there was heavy criticism, and then a view was taken that central banks need not focus too much on inflation. They should be flexible. So the flexible inflation targeting framework came from there, whereby you also take into account that your growth concerns or financial stability concerns, which could have impact on your growth. So that when we say plus minus 2%, basically flexibility is embedded in that plus minus 2%. But there is another flexibility apart from this. When the inflation target exceeds 6% for 3 consecutive quarters.
That's right.
So that's another flexibility you have. So if it doesn't, you don't have 6%, more than 6% inflation for 3 consecutive quarters, you don't have to do anything. So accountability gets fixed only once we have that 3 consecutive quarters. So basically the flexibility was inbuilt to take care of growth concerns. Now let me come to how the inflation targeting framework has performed. If you look at the performance of inflation targeting during the last 10 years, if you see the performance up to 2019, average inflation was about 4%. So it was close to the target. Up to 2019, inflation was close to the target. Yeah. But then comes the COVID pandemic, and COVID pandemic was a huge shock, and the fiscal dominance, in order to be, in order to have flexible inflation targeting, you should have absence of fiscal dominance. Like you should have reasonable fiscal deficit, debt to GDP ratio should not be high. Yeah. But the fiscal deficit shot up to from 3 point something to 9.2% after the COVID pandemic. So after the Ukraine-Russia war came, then the supply shock. So then we also had 2 episodes of large capital outflows. So if you see the performance of...
Mr. Raj, I hate to do this, but I just was given a slip which says that we are...
I'll just quickly
run through. If you can just be quick.
So my point is that if you look at the performance of inflation targeting, the first half up to 19 we did very well, but there was serious problem with the second half because of these exogenous shocks. But the issue is that average inflation is still close to 4.8% or so. Some people will say we have not achieved the target, but some people say that we have taken care of growth concerns. I would say that we are flexible inflation targeted. So in order to take care of growth concern, the Reserve Bank has decided to basically decided to miss the target. Otherwise, had Reserve Bank wanted, they would have hit the target, but then the growth would have suffered.
That's right.
So in their wisdom, they decided that because the shocks were huge. So it was considered that let's not sacrifice the growth much, but even if the target is missed, that's fine. Now let me come to the going forward, what should we do? See, it's not a good idea basically to exclude food from your target measure. My basic point here is if you exclude from the measure, you target only core inflation, there is no way you can anchor inflation expectation. And common man also pays for food and fuel. And communication becomes a huge challenge for the RBI. How the RBI communicates to the public that it's focusing only on the less than 50% of their consumption basket, it has absolutely no meaning. That's about the 4%, the core inflation.
Okay.
About the 4% inflation target, I would say that if actual inflation has been close to 5%, and I think the Reserve Bank has come out with a discussion paper where they find that even the trend inflation ranges from 4.1 to 4.7%. Then there's no reason for us to bring down the central target below 4%. Now coming to the range, tolerance band, we have exceeded the tolerance band in the last, if you take 106 months, 28 times, actual inflation was more than 6%. So I think it's very important for us to ensure that the inflation remains within the range most of the time. And if you're able to do that, then the tolerance band can be narrowed down. There was also suggestion of range versus central target with the tolerance band. I think range is not a good idea because you don't know that, first of all, communication becomes again a problem, like where you want to operate. If you have, let's say, 4 to 6% range, so again, the communication becomes a challenge. What you are targeting? Is it 4.2, 4.3, 5.4, 5.6? So the goal may change from time to time, which can confuse the market. And I really don't find any empirical evidence anywhere which suggests that the range has performed better than the
I understand.
inflation central target with the tolerance band. I'll stop here. Yeah.
So you are against the range actually?
I think that we should have a central target
Central
as we
target.
have
Okay.
with the tolerance band. Yeah.
Fair enough. Professor Sagar?
Thank you. Thank you for assembling this panel. I mean, pretty
Thank you.
experts on the monetary policy.
Yeah.
So I won't really be commenting much on this, but very quickly let me put in perspective that we had actually 3 phases of last 10 years inflation targeting framework. One was the clear success that we disinflated the economy when we introduced the inflation targeting framework. And we have to recognize that because inflation with all the metrics at that point what we had was averaging a little above 10 or little below 10 in 6 continuous years after the global financial crisis. So
Yeah.
we lost nominal anchor and we needed to get back the nominal anchor, and we got it through introduction of the inflation targeting. From 10-ish inflation, disinflated, the average for that period up to 2019 works out to be 3.9, just underneath the 4% target. Not many countries can boast of such a success. I mean, every country which has introduced inflation targeting framework have a series of misses, trying to establish credibility, and we could establish credibility, and Chetan compliments because you were one of the early members. So
Yeah.
we did it pretty well. Then came the supply side shock, and maybe you can blame me because in my period, inflation actually surpassed the target, and not just surpassed the target, but on occasions went above the upper tolerance band. The target is 4, the upper tolerance band is 6. There were a series of breaches which did occur, and which only goes on to show that we are not inflation nutters. So we are not Reserve Bank of New Zealand. We recognize that economic capital would be lost sizably, and so if economic capital is lost, the poor will get hurt the most. And we were conscious that poor will get hurt also because of high inflation, but the extraordinary circumstances were such that we had to save lives and livelihoods at that point of time. And we sort of had a little bit bad inflation record, but not like most other countries. You see how advanced economies lost control of their inflation. every advanced economy had inflation running up to 10% once the pandemic recovery was there. We didn't go that far. So I think even for the period of the pandemic, we have to qualify that it is reasonable success because it was extraordinary situation. And post that period, again, we are back observing inflation trend, which is mean reverting at 4. I'm not saying mean reversion is a cause for inflation targeting. In fact, we can bring a permanent change trying to lower the mean itself. And I think that's where inflation targeting should head, by tapping the inflation targeting and pull it down to 3% as Brazil has put down their inflation targeting. But I agree, this is not the stage we can do that. So any review would still have basically the same target. It makes no sense. I'm pretty puzzled why in the first place Reserve Bank put out a monetary policy framework review. I think they are damaging the credibility of the framework by putting that out. It should have been the inflation targeting review. If you are saying it's a monetary policy framework review, technically then the argument may be what the chief economic advisor and what Chetan was saying, that why not have multiple indicator approach? Do we have fixed exchange rate targeting? There could be any framework. I think we, by launching that debate, are underplaying the success of our existing system. And we should desist from that in a very uncertain term. On the core part, which Chetan very rightly pointed out, there is no cause for core. I mean, except for Bank of Thailand, which experimented it from 2000 to 2014, and then burnt its hand by having core inflation. No central bank does that. Even advanced countries' central banks don't do that. It is PC for US or core PC for US. They do PC essentially because their CPI is urban CPI. So everyone is converging on that. But for paucity of time, I don't want to go. There are a lot of other issues which I want to discuss, but there is limited time.
Thank you. Thank you very much for I will yeah.
What is for review in March 2026 is only the inflation, numerical inflation target of plus 4% plus minus 2%. What is under review is not the monetary policy framework.
You are clarifying
the numerical target, and the discussion paper rightly touches upon the 4 issues on that.
Exactly. That's what I pointed out.
Let me come to some important, I will just ask maybe 4 quick questions to all of you, and I would like maybe a 1-line or a 2-line response. I think we have broadly got a sense that most of you would like the headline inflation rate to be the yardstick. Am I right? Yeah. Now, if that is so, should the CPI index be changed accordingly? Or is that a related issue? I mean,
so CPI index will get changed because the base year will get revised on February of 12.
Food weight?
Of next. The food weight would come down.
All of you believe that it will get
from 45.8 to maybe 41.
All of you agree headline inflation is the right thing? And with the CPI index changing, it will even get better.
Not only that, now that MOSPI has come out with the very good idea of having a consumption, that household consumption expenditure survey every 3 years.
Yeah, that's right.
So my suggestion would be to review the CPI series every 3 years.
Every 3 years.
There's nothing wrong in that.
Make it more frequent.
As the incomes level rise, then you will be spending less and less on food. So that will give greater maneuverability to the RBI to conduct monetary policy.
Let me come to the more substantive, probably more controversial issue. We have a system in which the Monetary Policy Committee, the RBI, has a veto power. In a sense that you have, if there is a tie, then the RBI decides which way to go. Now, that's not what happens in the Fed. Now, the question is, should RBI retain a veto power, or should we follow the Fed principle that if there is a tie, we continue the status quo? So what's the view of this August panel? should RBI have a veto power? Let me start with Dr. Ghate.
I think by and large the framework has worked okay. I would not, even in the first MPC, there was some disagreement even within members of the Reserve Bank of India side of the MPC. There was some disagreement there, which showed that there was, differences of opinion across that. The job of the governor, and the governor, of course, and senior officials in the Reserve Bank of India are privy to much more internal information than external committee members are. And I think the challenge they face in every MPC is their ideal situation would be to forge a consensus. And they try very hard to do that. And sometimes you defer to that because they have inside information on things, which you may not necessarily have access to. So if you keep that in mind and you appreciate the fact that some segments of the MPC actually are privy to more information, I think in the end, and if you can get this consensus, then that's an ideal step because it shows unanimity over monetary policy.
Dr. Goyal, would you agree? And I'll tell you, add a little bit to that question, is that, in that situation where the RBI governor has a veto power, he actually has the final power to swing the policy his way because, the other members are after all members of the RBI. And, if whispers in the corridor are to be believed, there have been in the last 10 years where the RBI governors have actually, held their sway, I mean, so
Yes.
What would you say?
It's very rare for an RBI insider to disagree with the governor.
Exactly. So
think
if only the
one
RBI
who did
governor
that.
says,
Yeah.
listen, I want this policy to go like this,
So-
and he falls in line. And,
So
and
I
he,
think there needs to do two things.
Yeah.
One, I agree with Chetan that maybe we are too early to allow experts who very often might not be experts in monetary policy, like we're seeing with the current MPC, have a sort of deciding. But in two ways the system can improve. One is more internal discussion. It tends to be led by the governor's view. The view should come out of discussions. That doesn't always happen currently.
Okay.
And second, I think the press plays a very, very important role because I found when I had a dissenting vote, they wouldn't listen to me in the RBI on the MPC. The governor had already decided. But then when I was talking about explaining all the minutes and it would be picked up by the press, by the next meeting, they would be factoring some
So
of
you're
those.
saying veto power should continue, but there should be more discussion.
More discussion. And this is the key thing about inflation targeting, transparency.
That's right. Mr. Raj?
External discussion which influences.
Yeah, no, first of all, I would like to correct my good friend Chetan. Every single input on monetary policy which goes into the formulation of monetary policy is put in the public domain and it's also discussed. So what he basically, I think, is trying to say that the internal members have institutional memory. We have been working there for a long time, much more experience. I would put it that way. Yeah. But otherwise, every information goes into public domain and it is shared with all the members.
So RBI
so
should
what
have
I'm
the
trying to
veto
say that
power?
the governor has this casting, which is called casting vote.
Yeah.
But
Effectively a veto power.
veto power, but you cannot rule out in future, or it has not happened so far, but you can't rule out a policy whereby one of the internal members and three external members decide one way. In the case governor's second vote will not matter. Yeah. So that situation in future could arise.
Happen.
One never knows. But right now, yes, so far it has not happened.
But you are not in favor of a change.
No, absolutely. I'm not in favor of change for the same reason what I've explained, because though information is put in public domain, but because of we have been working there for a long time, the institutional memory, for that reason, perhaps the benefit of doubt should go to the
Okay. Professor
RBI.
Sagar, your view?
So very vexed question, I would say, but I would put it this way.
It's a biased question.
Vexed.
Vexed question.
Yeah.
Okay.
So
I was wondering.
The point is, I mean, very interesting debate already between the three of my other colleagues here on the panel. Let me provocate a bit more. You can take away the veto power, but before that, you think of doing that, should this collegiate body not be made that people who are on the collegiate body should be 24/7 into 365 day doing this work of MPC? They have a supported office and necessary information and people to back that up. Unless we go that route, taking away the veto power could be very counterproductive.
Fantastic. I think you have, my last round of questions before I come to this, I think we'll have only 1 minute left, I will combine these two questions. One is that, right now there is a slight crib in the media also that even though the letter that the RBI drafts and informs the government that this is why I could not meet the target is not made public. Now, does this panel think that in terms of, you make the minutes of the meeting public, but not a letter that RBI explains to the government. Now, is it a right decision or should it change? That's one. And second is the Monetary Policy Committee framework looks at everything, but the liquidity management is outside the scope of the Monetary Policy Committee. Now, should the liquidity management be brought under it or not? Or should it be left to, because the RBI governor can decide that this is the way I do it, this is the way, and maybe the monetary policy intentions can be neutralized to a great extent. So both these questions, quickly, we're short of time, start first.
Would you like to go first?
Okay.
Me?
Okay, I have a motive view about that, so let me be very straight on this. I think you can't segregate liquidity out of the monetary policy. That's not what the framework provides for. That's an interpretation of the framework that has come into being.
You mean it should be part of the monetary policy framework?
Yes. I mean,
so why is liquidity decision taken outside the monetary policy?
Must have a say not just on the policy repo rate, but policy reverse repo rate, the MSF rate, and should also discuss the monetary policy operation to achieve that. And should be part, the Fed does that.
Okay.
There is no harm if we do that.
Okay.
But that's my personal view, not
And
the
disclosure?
institutional view.
Disclosure?
Disclosure would come in the form of, if you have seen how the FOMC statement is, it does
No,
have
disclosure of when you...
Oh, the letter.
Yeah.
There is, again, no question that the disclosure should be there.
Made.
The Bank of England does that. The problem is it's not the RBI which is not disclosing. RBI is not disclosing because the Act doesn't provide for that. The government on its own can be free to disclose that. So
Well, a lot of
who is
people
stopping
say that it might tie the RBI's hands to a point
there is
where
a counter
argument.
So, in the sense that there may be certain market-sensitive decision as part
disclosure.
thereof.
That's
and
the only thing.
if you let that be transparent, it can affect its
Okay.
efficacy.
Mr. Raj,
No,
quickly.
No, I will not agree with Mridul.
You will not agree with him.
Let me say.
Oh, this is a really explosive panel.
One issue I agree on. So let me tell you.
Yeah.
The liquidity management is a whole day affair. The Monetary Policy Committee doesn't have any mandate now, and it is left to the governor, and governor has rightly decided that it should be left, it's with the RBI. But what the Reserve Bank must ensure is whatever the rate which MPC decides, so Reserve Bank should try to achieve that rate.
Okay.
Because otherwise you have decided that 4.5% is the right rate, but if the rate goes below 4.5%, then there is an issue. I would say liquidity management should not be with MPC, but the Reserve Bank should try to ensure that the rate is, whatever repo rate is there. But let me come to the letter now, which is very important. I am very categorically saying that the letter must be made public.
Must be made public.
Made public, absolutely.
Good.
All the central banks which write letter to the Treasury like Bank of England does or other right.
Wonderful.
They want the letter to be made
Dr.
public.
Goyal?
Yeah, the letter should be made public. It's part of transparency and inflation targeting. And liquidity management should not be with the MPC, but guidance on whether liquidity should stay in certain percentage surplus. And that is how it's done in the Fed and so on.
Okay.
That should be there. And just one point, I would say external members are essential because although they're saying, you need people to do monetary policy 24/7, but then they can also be groupthink and conservatism or bureaucratic objectives. So you need an outside view.
Sure.
And finally, just to balance between Mridul and Chetan, MPC 1 did very well, achieved 4%, but they had oil prices plunging. Yeah, MPC 2 had supply chain snarls and oil prices
COVID
rising.
and all that, yeah.
And we reached 5% average despite these terrible supply shocks. So that is a huge success of inflation target.
Okay, good.
Not just positive supply shocks, but negative also.
Dr. Ghate, your final words.
Both your questions are related because
Yeah.
on the liquidity management, because in COVID, what happened is that the liquidity infusion actually made the reverse repo rate the effective rate. And the MPC didn't have any control over the reverse repo rate. So the idea there is that the band becomes an instrument of monetary policy itself. And the fact that you make it asymmetric and you cut the reverse repo rate is basically disincentivizing banks to parking their money with the Reserve Bank of India and lending it out to the economy. So when you do have a big liquidity infusion of 5, 6, 7% of GDP, you are actually bringing the weighted average call money rate down, and it's gravitating towards, towards the reverse repo rate. So those questions, so in that context, yes, it should be part of the discussion, because in that particular instance, you needed a stimulus, and that stimulus had a repercussion, had an implication for the band as an instrument of monetary policy. I just wanted to say two things forward-looking: formality and climate change. In some recent work, we show that formality improves policy efficiency in the labor market. So that's something the government is working on, and it will need to work on over the next decades to improve policy efficiency. Climate change will increasingly challenge the credibility of central banking, because supply-side shocks will become recurrent. The credibility of central banks will get tested. Inflationary expectations will get unhinged. And since this is a panel on 10 years of inflation targeting, if we're looking forward, we're going to have to really seriously think about inflation targeting in a world where climate events are more frequent and more disastrous.
Oh, that's wonderful. I think, I'm sorry, I will not be able to take any questions because we already run out of time and they are all staring at me. But I must say that if this is the quality and the content that the Monetary Policy Committee members used to offer, I must say that this country, financial sector is in safe hands with such a wide variety of views, opinion. So India's monetary policy framework is alive and kicking. And with that note, we will end this session and I will give it back to Bhaswal. Thank you.